everyone. My name's Matthew Green. Welcome again to the Modelling Meetup. First of all, we'd like to thank Danielle and Plum. Danielle couldn't be with us today. I'm told by Eris that her client cancelled and so therefore she wasn't going to come up. But I'll take that all as hearsay, so therefore it's inadmissible. Eris, who, if you haven't met Eris already before, is Eris. Eris tonight is implementing or talking about understanding incremental cash flows and sunk costs. Eris brings with him his commercial advisor experience. He also says some work as a business development consultant. Eris runs Lazuli Consulting and describes himself as a financial modelling geek, possibly unfairly. Geek unfairly being applied.
You'll change your mind after this.
Right, very good. Well, we don't use geek in the pejorative approach anyway. So, ladies and gentlemen, Eris, thank you.
Thanks for coming, guys. I know this is a riveting topic. Some of you will fall asleep by the end of this, so hopefully we'll keep it a little bit interesting for you. Incremental cash flows and sunk costs are one of the most misunderstood or confused topics in financial modelling and is vital to actually doing proper valuation. So I'd like to start at the beginning because a lot of get back to the fundamentals and it often reminds you of something. Now I know I've scared you all by putting up a formula. That's it, that's the only one. And all I'm trying to do is make the point here is that a valuation is what you're prepared to pay for the discounted value of future free cash flows. What's the maximum you're prepared to pay? So you're setting a price. So for project evaluation, we've worked out our revenues, we've worked out our costs, we've worked out our capital costs. So for a project, we've already worked out what the three cash flows are, and we're just testing whether we're going to get an NPV of 0 or greater. So is that worth more than the cost? That's all we're testing. And that's the NPV rule in action. 0 or greater, you should invest. For an acquisition, we know what this is. We're working out what that is. So for an acquisition, we ignore the other company's capital cost, their financial structure. We don't care. It's our capital cost and what we're prepared to pay. For a pricing model, we know that. And we know half of that. We know what our operating costs are, then we're back solving to know what revenues we need to make an NPV of 0 or greater. Now, for a lot of commodities businesses, that doesn't count because the market sets the price, or you might have a very limited ability to affect that price. But for a lot of other industries, where you don't have a black and white market price, you can actually be doing a lot of pricing modelling. Now, most of us, fortunately, when we're doing projects, we get to do standalone project cash flows. You know, you buy the land, you build the plant, you install something, you buy things that you use up in it, you employ people, you insure it, you finance it. If you're in the digital economy, you're doing things with software and server farms. You make it, you market it, you sell it, you distribute it, and at the end of it, you might have something left over to sell, you know, whether it's plant or land, whatever, to try and make a bit of money back. So that's an incremental cash flow. We're all doing that. That's what the textbooks teach us to do. And if you can do it that way, please, for goodness sake, do it that way. That keeps your life and everyone else's life clean. So to complicate things a little bit, this was an example I did last year for a manufacturing company. They had a large multi-hectare site. They've had it for 25 years, and they'd only ever used half of it. They sublet the remainder out to 2 other businesses. And they were earning good rent income from those other businesses. And they called me in because they wanted to consolidate everything to a single location and kick the other tenants out. From a straight project point of view, ignoring the effects of getting rid of the sub-renting, it made a lot of sense. It was really NPV positive. It was a very good thing for them to do. But I upset the CEO, but made the CFO happy when I pointed out, well, hang on, you're actually making good income from an industrial site not too far from the city. So that's a good, valuable piece of land. So we have to take those foregone rents into account. So then you put in the foregone rent as a line, and you end up with the actual cash flow that you use for the evaluation, which is taking the rent into account. Now, disclaimer here, I've made up these numbers just to look pretty. I haven't even checked whether they actually make NPV 0 or greater, so please don't get carried away with the numbers. But the end result was it was still NPV positive, and they decided to go ahead with it. And plus, from a strategic point of view, it made a lot of sense for the business as well. So whether it's foregone revenues or operating costs, there's always something there which you're affecting, and you should look at that. But don't take it too far. I meet people who are looking for every single cost or opportunity cost or lost revenue that they can add in, and they kill everything they come across. And a lot of it doesn't make sense when you really think about it. So for example, when you buy land, the market value of land, as strange as it is to a lot of us who do discounted cash flows, that's already taking into account the income potential of that land in the future. So if you were to put in the purchase cost of land plus foregone revenue, you're actually double counting. So don't need to do that. Now, in mining industry and in corporate modelling, I'm coming across more and more instances where you can't isolate those cash flows. It's not simple. You're dealing with a large system, and a classic example would be the mining industry, where they've scheduled mining for the next 30 years or 40 years. They're going to have the same product tons every single year. The variable that they can play with is how much overburden they're removing, or that is, which pit are they mining at any time. So in the mine plan, they might have, in 10 years from now, we'll open that pit. Well, hang on, we need access to that lower cost coal now. So if you want to do that analysis of bringing that lower cost, the lower mining cost forward, how do you compare that? And the simple thing is that you have to model the whole system. And this also applies to corporate models. If you're putting through a change across all sites, and you can't just isolate that cash flow, then what you do is cash flow with the project and a cash flow without the project. Subtract one from the other, and you actually end up with the incremental cash flows. And I say that because I've seen a bunch of models or presentations before where people come in with that first line and go, look, we've got an NPV of $1 billion. I wish. They're taking credit for the existing operations profits. You can't do that. They're only, it might only be a $20 or $30 million project. You can't claim all that value. And the nice thing about this is, if you look at this, for example, you need a negative value to set up an internal rate of return calculation. And the board always wants to know internal rate of return. You do that with the incremental free cash flow. And that also works with net present cost as well. If you've got two net present cost lines, you'll usually end up with a capital cost or an upfront cost and then ongoing positive free cash flows. So modelling the business twice, if you need to, is the more complex form of incremental cash flows that you'll see, and you'll see a lot of that in resources and corporate level. Other examples which I see from time to time and like to make people aware of, because I've seen people try and reinvent this. It's all well-known theory. A lot of the time in government or councils, you are dealing with net present cost, not net present value, net present cost, because you're only looking at your capital costs and your operating costs. You're already delivering on a service, and you're looking at an alternative to deliver that service better. I'm not talking about headcount cuts. I'm talking about putting in new IT systems or new delivery methods, whatever it is. And you want to isolate the incremental cash flows. Well, it works perfectly well with net present cost too, the approach I just showed you with the mining side. Lease versus buy analysis, and I'll start with the disclaimer. I will lose respect for you if you try and completely reconstruct the lessor's cash flows and their assumptions. You're upset, I'm sorry. Yeah, a lot of companies do it. Everyone gets on the board and starts writing whack formula and what about this, and it's like an MBA class, and it's like you just pull out the book. There are 1,000 man-years of smart corporate finance professors have looked into this problem. Here's the half paragraph that explains it. The lessor gives you a series of cash flows which it will cost you to use that asset. You can go to the market and go, well, this is what I can buy it for, this is my cost of capital, therefore this is what it will cost me, including your depreciation benefits. Subtract one from the other, and then you know whether it's worth leasing or not, versus buying. The other one that you see more and more in let's call it tougher budget times at the moment, is you're comparing two options with unequal lives. Say, for example, you've got a machine or a smart light technology or whatever it is, a smart meter. One option has a 3-year useful life, another one has a 5-year useful life, another one has a 7-year useful life. Well, the traditional method is to say, well, multiply all those numbers together, so 3 by 5 by 7. I'm not going to do that in my head because I can't anymore. I've been on Excel for too long. And you end up with a model that's, however many decades long. That's a bit ridiculous. So a long time ago, they realized that the better approach is the equivalent annual cost. So what you do is you work out what's your, over the 3-year period or the 5-year period, what's your operating costs, what's your maintenance costs, and what's your capital costs, and work it out as an annual charge. And then if you've got your different options, you just compare that annual charge. And it's a very easy way to get across to the board. If this will cost you $1,000 a year, that'll cost you $1,200 a year, and that'll cost you $1,500 a year. Which would you like to do? And if you've got existing assets that do that already, then you can throw that in the mix as well. But because that includes sunk costs, that nicely leads us to sunk costs. Valuations are very simple. A pure valuation ignores any cash flows that occurred in the past. All you're doing is putting a price on, a price that you would be willing to pay to buy the business or the project that has those future free cash flows. How much are you willing to pay with your cost of capital? It's not actually a sunk cost, it's a proxy for a sunk cost. Now, I've got a bit of a rant here, and I've been getting this from some friends in the equity world and equity analyst world, starting to see major companies who I won't name, who are getting up and making presentations in public with a grin saying, we're NPV positive because we're actually covering our operating costs. Would you as a banker be happy with that? They're saying that they are not covering principal and interest payments.
I'm a banker, I'm not going to commit to anything in writing.
Yeah, okay, good. So what they're admitting in public is they can't cover their cost of capital. Go ahead.
I think the phrase that we like to see when we talk about this is they all talk about these non-cash impairment charges, which there was a letter from a shareholder I read once which said, yes, but they were cash when you spent them. So, that's just, it's a fallacy to think about it like that.
It is. It's absolute fallacy. And the example I like to give, one analyst gave to me, it's like saying you bought an apartment and then you set the rent at the corporate body fees. I mean, if you look at it that way, it's just like, yeah, well, that really doesn't make sense. I need to be setting the rent at a market rate. So there's a lot of this going around, and when you actually dig into it and talk to people, they start muttering about sunk costs. And so there's some misunderstandings there. So defining sunk costs in projects. Now, this is an area where I know a few of you are starting to get into projects or have been doing projects for a while. This is an area I admit to making mistakes in the past. You do a pre-feasibility study, then you do the feasibility study. Then if you're lucky, you get a financial investment decision, then you construct it, then you build, and then you operate it. The tax office, it's not just in Australia, it's most of the world, it's the IFRS rules. They're very nice. Guys, it was all uncertain when you did the study, therefore we'll allow you to expense it. So when you're doing your modelling, if your valuation's in the middle of your pre-feas study or something like that, you need to make sure you include your future study costs as an expense rather than a capital item. So that's one thing that a lot of people don't get, and I used to get this wrong as well, fully admit that. At the financial investment decision, yeah, the past doesn't matter. Or does it? People can't read that. I don't know many business people, CFOs or CEOs or investors who aren't going to scream and saying, hang on, I spent millions on this study. What do you mean it's not part of the calculation? What do you mean an NP of 0 doesn't include that? And corporate finance theory, you're going, sorry, got to live with it. So the CFOs of the world get together and they think, well, if these analysts are saying that it's only future cash flows, let's make it a future cash flow. Let's game the system. So, and look, there's some validity to this because studies and research and development and business development are generally paid out of either equity for small companies or they're paid out of retained earnings. So in order to pay your debt and to pay your dividends, you need to be getting a bit of extra money from somewhere. So in the mining industry and electricity industry, you often see a little unit charge. So the CFL will go $3 a megawatt hour for your wind farm to cover the study costs or cover the ongoing study costs. Sorry, they're very careful not to say it was the recovering from the past one. And you know, metals, you often get a little unit charge, a few cents a pound, something like that. And there's a level of reasonableness about it. If it matches on an annual basis the budget they spend, it seems reasonable. And I can't confess to anything, but I may have been involved with actually making sure those things recovered sunk costs in the past when I liked the CFO, but that's quite normal. The other way you see sunk costs recovered is through corporate overheads. Now, when I say that, corporate overheads are supposed to be just corporate overheads on an annual basis. But trust me, it's quite common for there to be a little bit extra in there. And my favourite is like, Steve, I really, your project, it's going to cost twice as much to administer all the others, so I'm going to charge you twice as much in corporate overheads. But somehow the total still adds up to 120% or 130% instead of 100% of the corporate overheads. So you get stiffed another way. And this often comes about because the CFO is often not at loggerheads, but there's a tension between the project team and the finance team going up to the board. So they're trying to keep the project honest or make the result sensible for the business. So your CFO gets that in. Then you get up to the board. The board hate your guts as well. What do you mean? We just not only 10 million on your project, but we're dropping 10 million a year on other projects. What do you mean we can't recover that? So they want to have a fiddle too. The classic fiddle, number one, is we'll only deal with projects that are NPV positive. Now, we all learn in the textbook and in the theory the NPV rule. If the NPV is 0 or greater, you're recovering your, do the project. That's the NPV rule. Now, there's a little bit of something to what they're saying, which is, we need to recover a bit more money in order to pay for studies ongoing. So chasing alpha or, getting a positive NPV is not dumb. The other thing they'll do, and you get a lot of risk-averse board members, it's quite common. A lot of companies that are doing a project, they're actually operating companies. They don't understand projects, they get nervous about it, and they just want you to add more risk to the project by reducing CapEx, reducing OpEx, or increasing CapEx and OpEx and reducing revenue. You read that last bit, if you get double counting or triple counting of that sunk cost, then you probably killed the project. And this is the bit you've got to guard against. It happens all the time. You try and have quiet chats with the CFO. You try and have quiet chats with the board if you can do that without getting fired, or the company secretary to get it to the board. If they're going to double count sunk costs, and then the other one I see is you do conservative cash flows, including risk, and then they add extra risk factors to the discount rate. So if you add risks everywhere rather than expected cash flows, one thing you're guaranteed to do is never do a project ever again, even though it may be exactly what the company is looking for. So if you become aware of, so everyone suspects that senior managers and board are really numpties, and I'll use the term in its proper meaning. If you come across that, then you've got proof. Before that, it's uncertainty, and you can give them the favour of the benefit of the doubt. Once you've got proof, find somewhere else where you don't have proof yet. You'll sleep better and you'll work better as an analyst. So the other side is valuations after project completion. Well, sunk costs have disappeared. The whole construction cost, it's gone, evaporated. We can only look at future cash flows. But this is that trap we were talking about before, where people are only recovering their operating costs when they construct their financial model. What they're not doing is capturing their long-run marginal cost. So the cost of repaying the debt, paying interest on the debt, repaying the equity, and the return on equity. So method number one, which I like because it's a lot simpler than a traditional project financial model, is free cash flows to equity. So that's gets rid of a lot of calculations. So debt's paid off, anything left over is available for the shareholders. And if you want to do any kind of return on equity measure, you can do it against the carried equity in the balance sheet. Impairment testing. Now, this is commonly done when there's been a big change in circumstances, like your plant isn't operating at full capacity, or if there's been a big change in commodity price. You are calculating the current market value of your assets, your non-current assets, based on the discounted value of future free cash flows. And I've got Eric half asleep here now. What you're doing there is saying, look, did you overcapitalise? We spent $1 billion on it, but now it's discounted. Sorry, its current carrying value is $1 billion, and we value the business only at $400 million. If you think that's a permanent change, then that's an impairment, and you write down equity. So when you write down equity, you make future shareholders happier because they're going to get, it's more easy for them to get the return on equity they like, but you're going to seriously piss off the existing shareholders because what you said is, we just pretended the $600 million you gave us there didn't actually exist. So impairment testing is another way that you see it done. Capital charge approach. Now this was really big in the early 2000s. Economic value added. Steve, do you remember economic value added, EVA? Oh. It was implemented largely as a way of trying to keep management honest in performance. But all it is a twist on the classic capital charge approach, which is very simple. You just work out the capital cost of the project as being, the debt and equity, say it's a loan amount, and the interest rate is your WACC or your discount rate, whichever. And then you work out an annual loan cost with your PMT formula in Excel. And then you can deduct that amount from your free cash flows and see if you're actually in positive territory. So are you actually being able to pay off debt providers and equity? Post-implementation review is one of the, I don't see it done often enough, I think. You've got a standalone project model that was done for the financial investment decision. You had all the assumptions for the model. The only problem is the valuation dates in the past. Well, if you want to know how the project is comparing now to what you thought it would be, that's the perfect place to put it, put in actuals. Now, is it technically a valuation? Well, yeah, it is, but it's using a different date. So you're not, the caveat here is you would never use that model to calculate acquisition price or sale price or anything like that. What you're doing is just simply a comparison like budget, what happened versus actuals versus forecast. So that's a powerful way of working out whether the revenues and the costs and everything are still working for you. If you can set price, and I say like power industry, you negotiate a power purchase agreement, or other industries where you can actually work out price or negotiate price, you can use those methods. Sort of the final twist. A lot of projects I do are one company selling a expensive multi-year or potentially multi-decade service into another company. And to do that, you will shape the equity cash flows. So what you might say is, first 5 years of the project, we won't take much to equity. We mightn't even take anything to equity. We want to make it look so good for you for the first 5 years in just straight cost, you guys will sign us up on the spot. So you back end the equity. It's called tilting it. You get more equity at the back, and you might even have a couple of big lumps of equity at the back. So when you've got lumpy equity cash flows, only the free cash flow to equity and the post-implementation review approaches will work, because the others are smoothed. It's the same annually. So that's it.